You might be surprised to realize that from 1974 all the way through the 1980 top in gold and silver stocks did not do much of anything. So then why would they do anything now? The answer is because this time it will be more like the 1971 to 74 gold bull market, which was at the beginning of a revaluation of gold, the end of the gold window, the end of the last vestiges of the gold standard. And we are now at the end of the last vestiges of the fiat money system, and gold and silver will be money once again. And at that point, gold stocks are going to go much, much higher.
The precious metals sector demonstrated mixed performance in 2024, with physical gold leading at a 28% gain, while silver and mining stocks showed more modest returns of less than 20%. Despite the underperformance of mining equities, technical analysis suggests the sector may be positioning for a significant breakout in 2025, with major indices like GDX and XAU developing substantial 5-year bullish base formations. Market analyst Rafi Farber of Endgame Investor offers historical context by examining parallel periods in precious metals markets. His analysis draws particular attention to two significant historical episodes: the 1970s, when mining stocks exhibited early strength before encountering increased volatility despite record gold prices, and the 1930s, when Homestake Mining demonstrated exceptional performance during the Great Depression, particularly following President Roosevelt's gold revaluation. Current market conditions present interesting parallels to these historical periods. For instance, Agnico Eagle, a prominent mining company, has maintained sideways trading patterns since gold's October peak, while reporting substantial quarterly profit growth of 165%. This divergence between operational performance and stock valuations may indicate untapped potential in the mining sector. Farber's analysis suggests that the contemporary financial landscape, characterized by increasing challenges to fiat currency dominance, could mirror historical patterns where precious metals reasserted their monetary role. Technical indicators signal oversold conditions for numerous mining companies, with some experiencing notable insider buying activity. These factors and the sector's consolidation patterns suggest that 2025 could mark a pivotal year for mining equities, particularly if macroeconomic conditions align. Specifically, analysts anticipate that economic deceleration and accelerated Federal Reserve easing policies could catalyze mining stocks to break out of their current base formations. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Let's go to the slides. So this, my friends, is a chart of Homestake Mining from 1969 to 1982. This is the premier gold stock. I guess the equivalent of Newmont would be today. So you see here 1969 to 1974. That is this first box over here, and I labeled it. We have a 5x increase in the first leg of the bull market. From 1974, 1976 was when the Treasury was busy selling gold to try to control its price, and we had a little correction in the midst of a bull market that went into 1980. But from 1974 until 1980, this stock, Homestake Mining, which could be representative of other gold stocks of the time, it actually went down. It did not even hit a new high in January 21st, 1980 top, with gold at 872 and silver at $50. It hit a new high later on in 1981 as interest rates maxed out. However, that was a short-lived high, and good luck timing that thing and expecting that you'd be able to sell at the top in this gold stock, as gold had already topped. Very confusing. I don't expect anyone to be able to sell at a high like this. So you could be saying then, and I would say, why would anyone want to own any gold or silver stocks now, given that this is what the gold stock sector did in the 1970s? Yes, granted, from 1971 to 1980 or 1971 to 1974, it went up 5.5 times. But then it became really, really volatile, and it was not really worth holding on to after 1974 so much. So here's the 1930s bull market, just so you can see how this stock, this is again is Homestake Mining, how this stock behaved through the crash of 29, through the New Deal, through Executive Order 6102, which mandated everyone give up all their gold to FDR, and the Dow bottom is somewhere in there in July 1932. So we see in the crash of 1929, This stock didn't do much of anything. There was a peak here, there's a trough here. It did go down in the crash and the liquidity crunch. This is October 1929, but went up immediately afterwards. It wasn't much of a dip at all. And then as New Deal spending picked up and we ended up into what began as a socialist system and continues to this day, New Deal spending into the 30s. This was as the Dow was falling and falling and falling and bottomed over here where it says Dow bottom. So this stock was going up and up and up gradually into the Dow bottom, but it really took off after the Dow bottom in 1932. And you can see here that it really started to take off after the Dow bottomed and reflated very slowly. The Dow never fully reflated until decades later. I think it was around the 50s or even the 60s, maybe. I don't remember exactly. But the point is here is that Executive Order 6102, when Roosevelt decided to pilfer the entire country's gold supply and stick it into Fort Knox, and most people complied with that, unfortunately. That is when the stock really took off. And so here in this next chart, we can see in the blue, again, is Homestake Mining, and in the black is the Dow. So we can see here is the top in the Dow in mid-1929. Here's the crash of 29 over here. And what was Homestake doing there? Homestake had a peak as the stock market in general peaked. It did trade in tandem. However, there was not a concurrent fall. There was no concurrent fall in Homestake Mining as the Dow kept getting lower and lower and lower, and the bubble deflated further and further and further. This stock just kept going higher and higher and higher. And see, here is the gold revaluation from $21 to close to $35. And at that revaluation, that is when Homestake Mining really started to take off. It really took off once the Dow bottomed over here. We have Homestake Mining over here, slightly above it. And then after the Dow started to reinflate slightly, nowhere near as where it was in 1929, but as the Dow started to reinflate after this whole monetary system had ended and we went into a new era of gold standard-esque monetary regime, that is when Homestake Mining really started to take off into 1936, reached a high then.
Recent analysis from the U.S. Treasury Borrowing Advisory Committee reveals concerning trends in the Treasury market's structural stability, potentially strengthening the case for gold as a strategic hedge. The committee's research indicates a steady decline in primary dealers' intermediation capacity over the past decade, measured as their total positions and financing of Treasury bonds relative to market circulation. This declining capacity coincides with unprecedented levels of Treasury holdings among primary dealers, which have reached nearly $400 billion, a dramatic increase from the 2014 average of $43 billion. This surge in holdings and regulatory challenges in controlling the U.S. borrowing pace suggest mounting pressure on market infrastructure. Market analyst Rafi Farber highlights particular concerns regarding market functionality as U.S. debt approaches $50 trillion, creating significant liquidity challenges. A notable shift in market dynamics has emerged as hedge funds increasingly assume the traditional role of primary dealers, implementing leveraged basis trades through substantial short positions in Treasury futures. This development introduces new vulnerabilities to the financial system, particularly during potential liquidity shortages. This situation underscores the importance of portfolio diversification, with gold potentially serving as a hedge against market volatility and systemic risks in the Treasury market. Let's get back to the interview.
Treasury's elite bond dealers will struggle to handle $50 trillion debt. Just wanted to go into a few key paragraphs here. Here is the first one that I wanted to highlight. They worry about the potential for the type of breakdown in Treasury market functioning that happened at the start of the pandemic, when investors rushed to sell bonds as panic set in. U.S. government debt sold off sharply until the Fed implemented an emergency backstop measures to limit the damage. The fear is that a confluence of pressures could strain liquidity and spur dislocations even without an obvious fundamental trigger. So essentially, they're saying this is going to happen randomly with or without a trigger, meaning it could happen in the year-end turn, which happens in the next 2 days, or it could just happen randomly in the time afterward. The other paragraph I wanted to highlight is this one. A key risk for the market is that if repo rates surge again unexpectedly, and dealers aren't in a position to step in, hedge funds may not have properly factored in that risk, triggering swift and violent deleveraging that would likely prompt the Fed to intervene. Regulators continue to fret about potential disruptions around the popular basis trade. We'll get into that in a second. A leveraged bet that seeks to exploit differences between cash treasuries and futures, given the prevalence of hedge funds on one side, who have stepped into a role formerly taken by primary dealers. And so what is this talking about? I will show you in one scary looking chart right now. This is the basis trade. It should scare the pants off any central banker, especially an American central banker, meaning anyone on the Federal Reserve Board. The blue line is the hedge funds, and it shows how short they are. Treasury bonds is exactly what that last paragraph was talking about, how the hedge funds have taken up the job of the primary dealers. The primary dealers aren't dealing with this for whatever reason, and instead the hedge funds are dealing with it by shorting treasury futures and buying spot. And that depends on futures being more expensive than spot, which reverses itself in a liquidity crunch as we saw in 2020. And this whole thing is forced to wind down, which is what happened in 2020 and 2019. So here we see the 2019 numbers. They were less than 2 million contracts, and here we see it's much, much worse. Now there's much more repo money involved in this. This is the very thing that is going to have to be violently deleveraged if cash runs out in the repo market, which it is, especially because QT continues, or the tightening of the balance sheet, which means that the Fed is taking dollars and retiring them out of existence, and the extra cash is being slopped up out into a black hole.
The shifting dynamics in financial markets reflect a critical juncture for precious metals and broader investment strategies. With structural strains emerging in the treasury market and historical patterns hinting at potential growth in mining equities, 2025 could present a transformative year. As systemic vulnerabilities increase, the appeal of gold and other tangible assets strengthens, countering economic uncertainties and market volatility. How do you see the evolving financial landscape influencing investment choices in 2025? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.